feeling like your investment strategy is maybe more of a gamble than a solid plan sometimes?
Yeah, or maybe you wish there was just like a guide that actually works, through all the market craziness. Something reliable.
Something that doesn't just chase the latest, hottest trend.
Exactly. What if there was a framework, like a core set of principles that's actually stood the test of time, decades of ups and downs?
A way of thinking that doesn't need you to have some, secret Wall Street intel, just
Mm.
a disciplined approach.
That's pretty much what we're diving into
That's
today.
here on the deep dive. We're tackling a real giant in the finance world, Benjamin Graham's The Intelligent Investor.
And this isn't just some dusty old book. I mean, people like Warren Buffett call it the investment Bible. Seriously.
Yeah, and our goal today isn't just to, sirize it. We want to dig in and pull out the stuff you can actually use.
The actionable insights, right? The wisdom you can take away and apply to your own investing, no matter if you're just starting or you've been at it for years.
So who was this Benjamin Graham? I mean, he wasn't just some ivory tower theorist, was he?
Not at all. He was deep in the trenches, started as a bond clerk, became an analyst, then a partner, and eventually ran his own super successful investment partnership. He really lived through massive market
He
swings.
saw booms and busts
Oh,
firsthand.
yeah. He had this knack for spotting bubbles that were just, unsustainable, like that Savile tire thing back in 1919.
What happened there?
Well, he saw the quick IPO return, sure, but he also spotted the red flags. So he wasn't shocked when the whole thing turned out to be a fraud. That kind of real-world experience shaped his thinking.
Makes sense. And he was huge on research, wasn't he? Like old school, digging through the details research.
Totally. That Northern Pipeline story from 1925 is a classic example. He went through these obscure regulatory filings, like really obscure,
Uh-huh.
and discovered the company was sitting on a pile of high-quality bonds worth way more than its stock price suggested.
Wow. So what did he do?
He bought in, pushed for bigger dividends based on those assets, and, well, made a tidy profit. That's the kind of value hunting he was all about.
Okay, so here's maybe the first big takeaway from him, right? He argued that being an intelligent investor isn't about having a genius IQ.
Nope, not about test scores or fancy degrees.
It's about having a solid intellectual framework for your decisions.
Right, a sound plan.
And crucially, the emotional discipline to actually stick to that plan, especially when the market's going wild.
Exactly. Buffett said it perfectly. Graham gives you the framework, but you have to bring the emotional control. That's the hard part.
Yeah. And Graham thought the crazier the market got, the better the opportunities for the investor who could just keep their head.
That's the key. Market folly is your opportunity, not your cue to panic.
Okay, so let's get into this framework, starting with a really basic but super important distinction he makes.
Yes, the big one. Investor versus speculator. Understanding this difference is, like, step one in Graham's world.
So how did he define them? What's the core difference?
It really boils down to your attitude toward market swings. The investor is looking to buy good businesses at fair prices. They're focused on the long-term value of the company.
Okay, steady long-term view. And the speculator.
The speculator is basically trying to guess. They're trying to predict short-term price moves, catch the next hot stock, time the market, aiming for that quick profit.
It feels like Wall Street kind of muddies that water, though, doesn't it? Graham pointed out how everyone who buys or sells gets called an investor,
Oh, absolutely. Still happens today. Doesn't matter why you're buying or what price you're getting, you get the investor label.
which is funny because he mentioned that survey from way back in 1948.
Right. Over 90% of people thought common stocks were basically too risky, like gambling.
Yeah. They were suspicious right when stocks were actually cheap and about to go on a massive run. The irony.
It's incredible, isn't it? Just shows how sentiment can be completely backwards.
And Graham was crystal clear about what counts as pure speculation. Things like buying on margin.
Definitely speculation. Borrowing money to buy stocks increases risk dramatically. Same with chasing those hot tips you hear about. He saw that stuff as basically gambling.
So what's his advice if you do feel that urge to gamble a bit?
His practical advice is, okay, if you must, take a small, and he really stressed small part of your money, put it in a completely separate account, your mad money account, basically.
Separate mentally and physically.
Totally. And here's the crucial bit. Never add more money to that speculative pot just because the market's been kind to you lately. That's usually the time to pull some out.
Don't let a lucky streak convince you you're suddenly a genius speculator.
Exactly. And absolutely do not let that speculative thinking infect your real investment decisions. Keep those worlds apart.
So the actionable insight for you listening is get really clear on your goals. What are you trying to achieve? And what's your actual tolerance for risk? Be honest.
Right. Are you building wealth slowly and surely, or are you trying to hit the lottery? Define that first.
And then keep those long-term investments completely separate, mentally and financially, from any short-term punts you might take.
Precisely. So, okay, you've decided you're an investor. Now, what does Graham mean by an intelligent investor? He was very specific that it's not about IQ points.
Right, not about being the smartest guy in the room doing complex math.
No. He defined the intelligent investor as someone who's patient, disciplined, and, importantly, eager to learn.
And able to control their emotions and think for themselves.
That's the core. He said intelligence here is a trait more of the character than of the brain. It's about your mindset, your temperament.
Which is actually kind of empowering, isn't it? He
Yeah.
believed the biggest hurdle isn't the market itself, well, it's us.
Exactly. Our own emotions, our biases, getting swept up in the herd mentality, that's the real enemy.
He even said he saw more money made and kept by ordinary people with the right attitude.
Then by finance pros who maybe had the brains but lacked that emotional control. Temperament trumps raw intellect in investing, basically.
So the practical step for you is to really work on that emotional discipline. Know yourself. Are you prone to panic selling? Do you chase hot stocks?
Yeah, recognizing your own biases and tendencies when things get choppy is like half the battle. Understand your triggers before they hit.
Okay, so we've got this picture of the intelligent investor patient, disciplined, emotionally controlled. How do they deal with risk? Because risk is unavoidable, right?
Totally unavoidable. And Graham is very direct about this. Your investments will go down in price sometimes. It just happens. Markets fluctuate.
So the goal isn't to somehow avoid risk completely.
No, that's impossible. The goal is to manage risk effectively, to make sure fear doesn't force you to abandon your strategy at the worst possible time.
And he really pushed understand make a history, didn't he? Looking back beyond just the last few years.
Oh, definitely. Understanding the big historical swings, the long-term relationship between prices, earnings, dividends, it gives you perspective.
Because history might not repeat exactly, but human behavior often does.
Pretty much. He warned against what he called bull market baloney, this dangerous idea that just because stocks have gone up for a while, they're somehow guaranteed to keep doing so.
Ask skeptical questions, right? If everyone thinks stocks are a sure thing, isn't it likely prices are already too high?
Exactly. And if prices are too high, how can future returns possibly match the past? It's simple logic, but easily forgotten in a mania.
That idea of the higher they climb, the harder they fall. Value matters.
Always. The price you pay determines your return, and, companies can't grow profits to infinity. There are limits.
He used the late 90s tech bubble as a prime example, didn't he?
Perfect example. Yeah, inflation was low, profits looked great on the surface, but the valuations were just astronomical for many stocks, totally detached from reality.
And then came the 2002 crash. Ouch.
Right. And even after that big drop, Graham noted that many investors still had these wildly unrealistic expectations about future returns. People have short memories sometimes.
He had that great phrase, the rule of opposites.
Yeah, basically that periods of extreme long-term optimism often set the stage for short-term disappointment. When euphoria is peaking, be cautious.
So the takeaway for you is be skeptical of those wildly bullish forecasts. Past performance is interesting, but it's not a crystal ball.
Focus on the real value of the business you're buying, its fundamental strength, not just the market mood.
Okay, let's talk portfolio strategy. For the defensive investor, someone who wants a sound approach without needing to be a stock-picking whiz, what did Graham suggest?
He proposed a really simple starting point, a 50-50 split between high-quality bonds and a diversified portfolio of common stocks.
50-50. Simple enough. But the key is managing that split, right?
Exactly. The magic is in the rebalancing. So if stocks have a great run and suddenly make up, say, 55% of your portfolio,
You sell some stocks.
you sell that extra 5% of stocks and put the money into bonds to get back to 50-50.
And if stocks fall and they're only 45%,
You do the opposite. Use some of your bond money to buy stocks, bringing it back up to 50%.
what's the big advantage of doing that? Seems like work.
Well, two main things. First, it automatically stops you from getting too loaded up on stocks when the market might be getting frothy and expensive. It forces you to take some profits.
Okay, built-in discipline.
Right. And second, when the market inevitably takes a dive, having that 50% in relatively stable bonds provides a huge psychological cushion. Your whole portfolio isn't crashing.
That makes sense. Less panic potential.
Definitely. And he even said, look, If you're really conservative, or if bond yields look much better than stock dividends at a particular time, maybe even go lower on stocks, maybe only 25%.
So it's not rigidly fixed at 50-50 forever.
No, you adjust based on conditions and your own comfort level. For bonds, back then, he liked U.S. savings bonds for safety. But he also discussed other government bonds, municipals for tax advantages outside retirement accounts.
Then the whole bonds versus bond funds question.
Right, basic fixed income stuff. He also noted how strange it was that stocks went from being seen as super speculative in '49 to supposedly safe at market peaks later on. Perceptions shift dramatically.
And for the stock part of this defensive portfolio, he wasn't keen on chasing growth stocks, was he?
No, he thought they were generally too unpredictable and risky for a defensive approach. He preferred focusing on large, established companies that were perhaps a bit out of favor, maybe relatively unpopular, and trading at reasonable price-to-earnings multiples.
So for the defensive investor listening, consider this balanced approach. Bonds and stocks. Understand their roles.
And really embrace that rebalancing. It's a powerful, if simple, tool to keep your strategy on track and manage risk.
Okay, let's shift to common mistakes. Graham saw investors making the same errors over and over. What are some big pitfalls to avoid?
Well, one that sounds good on the surface is buy what you know. Peter Lynch made that famous.
Right. Invest in companies whose products you use or understand. Makes sense, kinda.
It can be a starting point for research, sure. But Graham warned, even defensive investors got to do their homework. Just because you like a company's coffee doesn't mean its stock is a good buy at any price.
He used that AAA Enterprises example.
Mm-hmm.
Company everyone knew.
Exactly. Went public, stock doubled quickly, then crashed to pennies and went bankrupt. Familiarity is not a substitute for financial analysis.
Ouch. Okay, what else? He warned about dying a trader's death.
Yeah, the danger of too much buying and selling, especially day trading, that constant urge to be active, to time things perfectly.
It feels productive, maybe.
Feels productive, but it usually just eats away at your returns. Most day traders lose money, facts. Plus, you've got transaction costs and that market impact thing, paying a bit more to buy, getting a bit less when you sell. It adds up.
What about IPOs? Initial public offerings.
Right.
Always lots of buzz around those.
Graham was pretty skeptical. He pointed out, yeah, you hear about the Microsofts, the huge winners, but you forget the vast majority of IPOs that end up being duds or worse.
Survivorship bias.
Totally. And often, the really big gains are made by the insiders and institutions who get in at the initial price before it even starts trading publicly.
What about growth stock mutual funds? Did he look at those?
He did. And his findings, which still largely hold true, were that the average growth fund struggles to beat the overall market in the long run, especially after you factor in their fees.
And chasing last year's winner doesn't usually work either.
Statistically, no. Past performance is notoriously poor at predicting future top performers among funds.
Which leads nicely into index funds, Graham's view.
Later in life, he became a big proponent. He saw them as the most sensible option for most individual investors. Low-cost, instant diversification. Buffett obviously agrees strongly.
They might seem boring, just matching the market.
But boring can be beautiful in investing. Their effectiveness over time is hard to argue with, especially given the low fees.
And when should you sell a fund? If it's underperforming for a bit.
Not necessarily. He used the Sequoia Fund as an example, great long-term record, but it lagged the S&P 500 in some early years. Selling then would have been a huge mistake.
So you need to understand the fund's style.
Exactly. Understand their strategy. Are they value-focused? And value is just out of favor right now. Selling, just because their style is temporarily unpopular, is often how people lock in losses, buying high and selling low. The classic mistake.
Okay, lots of pitfalls there.
Yes.
So, key advice. Avoid chasing fads. Be super careful with IPOs. Seriously consider low-cost index funds. And understand your fund's strategy before bailing during a slump.
That sums it up well. Now, what about getting advice? Where should people turn? Graham looked at everything from relatives to brokers to professional counselors.
He found it kind of messy, right? No clear, reliable system.
Yeah, a bit of a Wild West. His main point was, if you're going to rely heavily on someone else's advice, you've got two basic choices.
Okay.
Either stick to super standard conservative investments things almost everyone agrees are sound, or you need to have incredibly deep trust and understanding of your advisor, especially if they're suggesting something unconventional.
You need to be able to judge their judgment, basically.
Right. If it's just a normal business relationship, you should only go with unusual ideas if you personally have enough knowledge to evaluate them properly.
What about the different types of advisors? Like fee-based planners.
He noted they tend to make more modest promises. They usually stick to standard stocks, bonds, focus on established companies, and don't typically try to time the market aggressively.
And brokers at brokerage houses.
They provide lots of info, yeah.
That-
But Graham cautioned that their analysts are often pressured to give short-term predictions. Is this stock going to go up soon? That focus can hurt long-term thinking. The value you get depends a lot on the questions you ask.
What about firms that underwrite new stock issues? The ones selling IPOs.
Big potential conflict of interest there. They're advising the company bringing the stock public, and they're selling those shares to you. History shows that in hot markets, some pretty questionable companies get sold at inflated prices this way. Don't just trust the salesman.
So, if you're looking for an advisor, how do you check them out? Do your due diligence.
Absolutely critical. Check their background. Look for disciplinary actions, complaints. Your state securities regulator is a good place to start. Check accounting regulators, too. It's all public record, usually.
And what questions should you ask them directly?
Good ones. Ask about their typical clients. How specifically will they help you reach your goals? How do they track progress? What's their investment philosophy? And can they show evidence it works? And really important, what do they do if an investment performs badly for, say, a whole year?
Yeah, if their first instinct is just sell, maybe they aren't long-term focused.
Could be a red flag for a value approach, yeah.
So, the bottom line on advice. Be critical. Understand motivations and biases. Do your own homework. Ask tough questions. Don't just blindly follow.
Couldn't say it better. Okay, let's get into analyzing the securities themselves. What are Graham's core principles here? The absolute bedrock is the margin of safety.
Margin of safety. We hear that phrase a lot. What does it actually mean in practice?
Okay, for something like a bond, it's pretty straightforward. It's about how much the company's earnings cover its interest payments. Like, if earnings are 5 times interest payments, that's a bigger safety margin than if they're only 1.5 times.
A buffer against earnings falling.
Exactly. But it applies just as much to stocks. For stocks, it means buying at a price significantly below your conservative estimate of the company's real underlying value, its intrinsic value.
So you're building in room for error?
Okay.
Or
Yeah.
just bad luck?
Both. It's acknowledging you might be wrong in your analysis, or things might just go unexpectedly bad for the company or the economy. It's financial humility, built right in.
And he warned about buying weaker companies even when the economy's good.
Big time. Just because a company is making money now during a boom doesn't mean it has true long-term earning power to survive a downturn. People extrapolate good times too easily. Present prosperity doesn't guarantee future safety, especially with shaky foundations.
And this all comes back to doing the work, right? Thorough analysis is non-negotiable.
Absolutely, it's the foundation. No shortcuts. No relying on hunches or headlines.
He even said you could find a margin of safety in things that seem speculative, like stock warrants.
And it's a big if you do the rigorous analysis. If you buy them at a really low price where the potential upside massively outweighs the downside risk you've carefully calculated, it's still about analysis, not gambling.
And diversification helps widen that margin.
Definitely. Spreading your bets across different well-analyzed securities reduces the impact if any single one goes wrong. It adds another layer of safety.
Okay, key points for analysis. Always demand a margin of safety. Dig deep, beyond the surface numbers. Understand the difference between price and value, and diversify.
Precisely. Now, let's talk about earnings per share. Those numbers everyone focuses on. Graham had some important warnings here, too.
Yeah, he said something kind of contradictory, like, don't focus too much on 1 year's earnings, but also watch out for booby traps in short-term numbers.
Exactly. Because while the long-term trend is what matters most, the market reacts strongly to quarterly or annual earnings. So you need to be aware of how those numbers can be manipulated or at least presented in a misleading way.
Like his ALCOA example from 1970.
Right. They reported several different earnings figures with various special charges deducted or not deducted. It made it really hard to figure out what the company actually earned from its ongoing operations that year.
And he wasn't a fan of pro forma earnings, was he?
No. The idea was supposed to be showing underlying trends by excluding one-off events. But he saw companies increasingly using pro forma numbers to basically paint a rosier picture than reality, like pretending an acquisition contributed earnings for a full year when it only happened halfway through.
Sneaky. What about aggressive revenue recognition, like that Quest example?
Yeah, that's booking revenue too early. Quest was booking the entire year's revenue from Yellow Pages ads as soon as the books were printed, even though customers paid monthly. It makes the current numbers look better, but it's not sustainable or accurate.
And pension fund assumptions. How can that distort earnings?
Well, companies have to estimate how much their pension investments will earn in the future. If they use really optimistic assumptions, it makes their current pension costs look lower, which boosts reported profits now.
But if those returns don't actually happen later?
Then they have a big shortfall down the road. It can hide problems. He contrasted SBC's optimistic assumptions back then with Berkshire Hathaway's more conservative approach.
Got it. So when looking at earnings, be skeptical of single-year figures and pro forma adjustments. Look for consistency and transparency. Understand how accounting choices can impact the bottom line you see.
You got it. Now, for that defensive investor, again, the one wanting clear rules, Graham actually provided a specific checklist for picking stocks.
Okay, practical criteria. What did he look for financially?
First, enough diversification, minimum 10 stocks, ideally up to 30. Then financial strength. Current assets should be at least twice current liabilities. And net current assets, that's current assets minus current liabilities, should be greater than all the long-term debt.
So a strong balance sheet. What about earnings and dividends?
He wanted earnings stability, some profit every single year for the last 10 years, and a long dividend record, uninterrupted payments for at least the last 20 years.
20 years of dividends. That filters out a lot.
It does. It points towards stable, mature businesses. He also advised avoiding really small companies due to higher risks and potentially higher trading costs.
And the price. What rules of thumb did he give for valuation?
Two main ones. Don't pay more than 25 times the average earnings over the last 7 years, not just last year's earnings.
Okay, smooths out the bumps.
Right. And don't pay more than 1.5 times the company's book value. Lower is better, obviously. But 1.5 times was his suggested upper limit for a defensive pick.
So for defensive listeners, use these criteria. Look for financial strength, stability, long dividend history, reasonable size, and don't overpay based on recent earnings or book value.
That's a solid framework for a defensive stock portfolio right there. Now, what about the investor who's willing to put in more work? The enterprising investor.
All right, the one doing more digging. Where did Graham suggest they look for opportunities?
He pointed to three main areas. First, relatively unpopular large companies, big established firms going through a temporary rough patch that the market might be overreacting to.
Okay, buying when there's blood in the streets, kinda.
Sort of, yeah. Second, special situations, things like liquidations, reorganizations, mergers. This stuff requires real expertise, and diversification is crucial because things can go wrong.
Not for beginners.
Definitely not. And third, what he called bargain issues, specifically stocks trading below their net current asset value, basically worth more dead than alive based just on working capital, often found in troubled companies.
Fascinating. He also mentioned convertibles and warrants.
Briefly, yeah, but he noted they're more complex instruments, generally not for a conservative portfolio. An enterprising investor might explore them, but needs to really understand the risks and mechanics.
So for the more active folks listening, these are areas to explore if you're willing to do the deep research. Unpopular large caps, special situations, bargain issues, but know the risks involved in each.
Absolutely. And whether you're defensive or enterprising, that margin of safety principle always applies to stock selection. It's non-negotiable.
Remind us again, buying at a low enough price.
To allow for things going wrong. Errors in your analysis, unexpected bad news for the company, whatever. It's your cushion.
And he was especially cautious about applying this to growth stocks.
Very, because predicting future growth accurately is incredibly difficult. So paying a high price today based on rosy future projections is inherently riskier.
So focus on value you can see now based on demonstrable earnings.
That was his emphasis. The actionable insight is always aimed to buy at a discount to what you can reasonably determine the business is worth today. Be wary of paying up for hope about tomorrow.
Okay, let's talk about one of Graham's most famous ideas, the Mr. Market analogy. Can you break that down for us? It's such a powerful concept.
It really is brilliant. Okay, imagine you own a share in a private business, and you have this partner, Mr. Market.
Yeah.
He's manic depressive.
Oh.
Every single day, he shows up and tells you what he thinks your share is worth. And he offers to either buy your share from you at that price or sell you his share at the same price.
Every day, a new price.
Right. And the price is totally driven by his mood. Some days he's euphoric, wildly optimistic, and quotes a ridiculously high price. Other days he's inconsolably depressed and offers you a price that's way, way too low.
So what's the lesson from dealing with this emotional partner?
Graham's point is, You don't have to play his game. You don't have to feel euphoric just because he does, and you certainly don't have to panic and sell just because he's depressed, provided you know the underlying value of the business hasn't actually changed that much.
His mood swings are his problem, not necessarily yours.
Exactly. You should use his moods to your advantage. When he shows up feeling suicidal and offers you a crazy low price for a perfectly good business, maybe you buy more.
Take advantage of his pessimism.
Right. And when he's jumping for joy and offers you a price far above what the business is really worth, maybe you think about selling to him.
Use his mania to your benefit.
Precisely. The key is to focus on the business's actual performance and your own assessment of its value, not the daily price quotes from your erratic partner. Mr. Market is there to serve you, not to guide you.
So, develop your own independent valuation, ignore the noise, and potentially profit from the market's irrationality. Powerful stuff.
Absolutely. And this ties into his final point about viewing yourself as a shareholder.
Right, not just owning a ticker symbol, but part of a real business.
That shift in mindset is crucial. It means you should actually care about understanding the company, what it does, its competition, its management.
And you have rights as an owner.
You do. Voting your shares via proxy, attending shareholder meetings if you can, engaging with management. Graham believed shareholders should act like owners.
He mentioned independent directors, too.
Yeah, he saw the value in having objective, experienced people on the board looking out for all shareholders' interests, holding management accountable.
And what about dividends versus the company keeping the earnings?
Graham felt the burden of proof was on management. They needed to convince shareholders that reinvesting profits back into the business would create more value for the owners than just paying those profits out as dividends.
Be skeptical if they're just hoarding cash without good reinvestment opportunities.
Exactly. And he was also wary of excessive stock splits, seeing them mostly as hype generators that don't add real economic value.
So the actionable insight. Think like an owner. Understand the business. Use your shareholder rights. Pay attention to dividends and how management uses capital.
That's the essence of it. Now, the commentary in newer editions of the book often adds some modern context, too.
Like what kind of things?
Well, things like TPS, Treasury, inflation-protected securities, which weren't really around in Graham's main writing days, as a way to hedge inflation risk.
Good point. What else?
It often reinforces Graham's skepticism about market timing, still hard, maybe impossible for most people. And it discusses the concentrated versus diversified portfolio debate.
Graham generally favored diversification, right?
For the average investor, yes, definitely, for that margin of safety. But the commentary acknowledges that some legendary investors, like Buffett, built fortunes through concentrated bets in companies they knew incredibly well. But that takes extraordinary skill and temperament.
High risk, high potential reward.
Right. For most of us, diversification is safer. The commentary also brings in behavioral finance concepts.
Like loss aversion, how we hate losing more than we like winning.
Exactly. Understanding that bias helps you avoid panic selling. Thinking about drops in percentages, not just points, can also help keep perspective.
And mutual fund performance. Does the commentary update Graham's findings?
Largely confirms them. Most active funds still struggle to beat benchmarks after costs. It reinforces the case for low-cost index funds as a very solid core holding for many.
And modern accounting tricks.
Oh yeah. Pro forma earnings are still around. Stock option accounting can be complex. Pension assumptions still matter. Special purpose entities, aggressive cost capitalization, all things to watch out for. Still need to scrutinize those financials.
So the need for diligence hasn't gone away.
Not at all. If anything, it's increased. And the commentary always circles back to the importance of a long-term perspective.
Which brings us nicely to Graham's overall legacy, this idea of Graham and Doddsville.
Yeah, Buffett's term for that intellectual community of investors who stick to the core principles. Focus on intrinsic value, demand a margin of safety, treat stocks as businesses, and have the right temperament.
And the success of investors who follow this path, Buffett, Walter Schloss, many others.
It's remarkable. It really speaks to the enduring power of these fundamental ideas. They just work across different markets and different times.
So the ultimate takeaway for you listening is to really embrace these principles. Focus on buying good businesses for less than they're worth.
Okay, let's try to wrap this amazing deep dive into the intelligent investor up. What are the absolute key takeaways you can start using today?
Right. Number one, think long term. Investing is a marathon, not a sprint.
Absolutely. Number two, prioritize value over speculation. Know the difference and stick to investing.
3, manage your emotions. Your own psychology is often your biggest enemy. Recognize biases, stay disciplined.
Crucial. 4. Understand what you own. Treat stocks like ownership in real businesses, not just ticker symbols.
5. Diversify. It's a key part of managing risk and widening your margin of safety.
6. Be skeptical. Question market hype, question rosy predictions, question your own assumptions.
And maybe most importantly, 7. Always demand a margin of safety. Buy with a buffer.
That's the core. And Graham's central message, maybe the most powerful insight of all.
Is that intelligent investing is more about character patience, discipline, humility, than it is about having a genius IQ or secret information.
Exactly. The power isn't in finding some magic formula. It's in adopting a sound framework like Graham's and having the discipline, the emotional strength to actually stick with it, especially when things get tough.
That's what lets you potentially profit from market folly, instead of just participating in it.
Couldn't have said it better. It allows you to turn Mr. Market's moods into opportunities.
We really hope this deep dive has been helpful. We strongly encourage you, if you haven't already, to pick up Graham's The Intelligent Investor. It's dense, but the wisdom in there is truly timeless.
It really is a book that keeps on giving the more you revisit it. Thanks so much for joining us today. We hope this gives you some solid, actionable ideas for your own investment journey.